Good morning. It's Tuesday, the 20th of August, and this is Govindraj Ethiraj, headquartered and broadcasting as well as streaming from Mumbai, India's financial capital. The take. How safe is my money? India's Finance Minister Nirmala Sitharaman on Monday met with public sector banks and urged them to improve their deposit growth. Deposits have been growing at 300 to 400 basis points lower than the credit growth in the last few months, creating what is known as an asset-liability mismatch for banks. The minister asked the bank's chiefs to focus on core banking business and increase the pace of deposit growth by introducing innovative products, according to news reports, which also quoted her saying earlier this month that there was a mismatch indeed between deposit and lending growth. At that time, she said that growth in lending is higher. I will be meeting banks on August 19th for various reasons, and in that process, I will be talking to them about the importance of deposit collection. She also said that the Reserve Bank of India had given banks the liberty in terms of interest rates and that that's the banks, should make deposits more attractive. The Reserve Bank of India Governor Shaktikanta, under whose broad umbrella all of this falls under, also asked banks to mobilize deposits through innovative products and services by leveraging their vast branch network, which, as you know, both in the case of public sector banks and private sector banks, is only growing despite all the talk of digitization. Now, he said that banks are taking greater recourse to short-term non-retail deposits and other instruments of liability to meet the incremental credit demand. This, as he emphasized elsewhere, may potentially expose the banking system to structural liquidity issues. Now, we've been, of course, discussing this almost every other day on the core report, but I would say that there are an increasing number of perspectives to this. First, we said that people are not depositing money in banks because they're putting it in real estate and the stock markets, or worse, speculative trades like derivatives, or for the even braver ones, cryptocurrency. Of course, in many cases, the money barely touches the bank account, taking off the moment it lands via a monthly salary or some other income. High aspirations and high inflation have pushed people to take money out of bank deposits and put them elsewhere. So we are in a situation where the economy will need more bank credit, but banks are finding it tough to lend and maintain that healthy gap or balance or ratio between deposits and lending. It's not that they are not getting deposits, it is that they're not getting enough. So that brings me to the fundamental question that I could pose and leave here for the day. How safe is your money? Now, safety is a relative virtue. Some people might feel that the safest place for money or their savings is under the mattress. Others might prefer the bank deposit, while the rest would want to make their savings work harder and thus invest it in attractive financial instruments, or for that matter, real estate. Generationally, I can see why fixed deposits at, let's say, 7% are unattractive. There's no way you can beat inflation in the real sense with this. And when I say inflation, I mean the rising cost of living that we experience every day, and not just the statistic, which can be misleading somewhat, at least for the purpose of computing our own spending. I can also see that it will only take a shock or two for people to start switching again, which is to, let's say, something like bank deposits. But that's not a point one wants to reach or to wish on anyone. Now, bank deposits are not attractive because people don't give enough importance to safety right now, or believe that sacrificing safety for the likelihood of a higher return despite the risk is totally worth it. I'm not sure whether increasing the interest rates, let's say to 8% or 9%, will dramatically change the game, even if the banks can do so. Banks have to convince us that some part of our savings must also be protected from extreme or higher risk, and that when things go south, as they tend to do, whether it is real estate or stock markets, then the only money that is sitting safely is your bank account or your fixed deposit, which you can access easily and pull out. Now, admittedly, this is not an easy sell for banks at a time like this. But equally, it's not the bank's problem alone that they're not raising sufficient deposits to meet their lending needs. The problem, I feel, is ours too, for believing that putting money into risky assets somehow equals savings and thus safety. And that brings us to the top themes for the day. The stock markets are listless and standing by. India's usually strong rupee has weakened when most other currencies have risen. How iron ore went from being the hottest commodity to almost nothing. And of course, the India angle. Why a minimum tax rate for global digital multinationals like, say, Netflix and Amazon might take longer. India's domestic aviation sector continues to grow. And candy giant Mars is buying the parent of chips brand Pringles in a mega $36 billion deal.
This is the Core Report with Govindraj Ethiraj.
The markets are listless. The stock market started on a somewhat strong wicket for the week on Monday, but then lost steam quickly to end flat as no clear cues were visible. The BSE Sensex was down 12 points at 80,425, while the NSE Nifty was up 31 points at 24,573. So all in all, a flat market. The top gainers were Hindalco, BPCL, Shriram Finance, Tata Steel, LT Mindtree, Coal India, ONGC, and Dr. Reddy's Laboratories, all between 1.8 and 4% according to Business Standard. The BSE mid-cap and small-cap indices were all up much more, between 0.5% and 1% approximately. Speaking of cues, the world markets are focused on Wall Street, where there appears to be some confusion as well. In an indication of how the big brokerages and banks can be as whimsical or unsure about their assessments or perhaps wrong, Goldman Sachs has now reduced the probability forecast for a US recession to 20% shortly after raising it. So why did Goldman do this? Well, because fresh labor market data sparked a reassessment of market views in the economy, according to CNBC. Just earlier this month, Goldman economists had raised their 12-month US recession probability from 15 to 25%. And then came the July jobs report, which showed non-farm payrolls grew by a less than expected 114,000. And now this was down from the downwardly revised figure of June and below a Dow Jones estimate as well. The other figure was retail sales for July, which rose by 1% versus an estimate of 0.3%. And weekly unemployment benefit claims, which are lower than expected, according to CNBC. Now, all of this is a little specific. But the fact is that Goldman did an about turn. This also means that their estimates of all these figures, including jobs data, were quite likely off the mark. Nevertheless, Wall Street has been holding positive overnight. So we touched upon safety, and of course, gold comes to mind, whose prices are lower in India right now thanks to a much delayed reduction in customs duty following an increase in customs duty, which should have never happened. Gold prices have been hitting new highs, and analysts now expect more records, with some forecasting it will hit $3,000 per ounce next year as a US Federal Reserve meeting draws closer, according to CNBC. The Federal Reserve, which could see an interest rate cut, is slated for September, which I'm sure you know since we talk about it so often. Spot gold held steady at last session's record high of $2,508 per ounce, according to data from FactSet, quoted by CNBC, while US gold futures jumped slightly to set a new record of $2,540 per ounce on Monday. Analysts told CNBC that 2024 was the year where gold was supposed to reach multiple highs, alluding to its appeal as a safe haven asset. And if that happens, expect prices in India to rise too. The rupee does not hold against other currencies. Elsewhere, the rupee has risen to its highest level in nearly 2 weeks on Monday as the dollar index declined to its lowest level in 6 months, sparking broad gains in Asian currencies, according to Reuters. So the rupee was about 83 rupees 90 paise on Monday afternoon. A research report from Bank of Baroda Research says that if we were to position rupee movements with those of other countries, the rupee depreciated while most other currencies appreciated. The rupee has depreciated just 0.27% in recent weeks, but 14 other currencies appreciated in relative terms. The Australian dollar, British pound also declined by less than 1%. BOB research says that trade data has indicated a higher deficit as exports growth declined in July. Now, there is no clear trend in foreign portfolio investment flows into India either, as BOB research points out, saying that foreign portfolio investors up to August withdrew about $700 million, mostly in equity, against the roughly $2 billion that they brought in the previous fortnight. The story of iron ore. We've been discussing here how steel prices in India are at a 3-year low, and Indian companies have filed anti-dumping petitions against steel coming from Vietnam with the Ministry of Commerce. We also touched upon how massive oversupply in China is shaking up the global steel sector after the real estate sector in China started slowing down. And of course, how iron ore prices were hitting new lows. An interesting article from Bloomberg points out that of all commodities, this humble lump of iron ore benefited the most from the Chinese economic boom of the last 25 years. So much so that iron ore prices went up nearly 10 times in the last 30 years, more than any other commodities, creating billionaires and Wall Street favorites. Some of those billionaires, by the way, I'm not sure of the exact numbers, were created in states like Goa. And now it's over, says Bloomberg, pointing out that the cost of the reddish dirt, which turns into steel inside blast furnaces, has fallen already below $100 a metric ton, which is down 55% from its all-time high of almost $220 a ton in 2021. But the outlook is the issue, not the current price. Bloomberg says the outlook looks somber as Chinese steel demand reaches a zenith, and it's becoming clear that China hit peak steel demand somewhere between 2020 and earlier this year. And the reason? The shift in its economic model to services and away from heavy investment and housing construction, and thus China could not, and the government sets to set these paths, will not follow that path set previously. So, what does this mean for India? Well, China makes more than half of the world's steel, and India is the second biggest. But we're talking about iron ore. While India could see stronger steel demand for longer, India actually exports iron ore to China, almost 90% of it at peak and about 80% on average. So, which means only 10 to 20% of the iron ore mined in India is used in India, or maybe even less, because there are other countries who are importing as well. Meanwhile, India's iron ore exports have been rising sharply by about 118% in the last year to about 48 million tons. So, the slowdown in China's steel industry will also affect Indian iron ore producers in price and output because of the surplus that could continue for several years. A minimum tax rate for global MNCs. One of the items expected to be proposed in the Union Budget 2024 in India last month was a draft legislation on the global minimum tax for multinational enterprises. The legislation would have paved the way for changes in India's tax laws. Now, that did not happen, more on why shortly. But the global minimum tax, just to give you a background, also known as the Pillar 2 regime, aims to prevent multinational enterprises from shifting their profits to low-tax nations. The tax regime hopes to ensure that they maintain an effective tax rate of 15% across all jurisdictions where they operate. However, at an ad hoc intergovernmental committee that approved the United Nations terms of reference with an overwhelming majority of 110 votes, 8 countries, including the G7, that's US, UK, Canada, Korea, Australia, Israel, and Korea, voted against it, while 44 nations abstained. So, what is the import of this move, and where does this leave the larger effort to bring about a minimum tax rate, particularly for the large digital multinationals whose products and services most of us consume? I spoke with Mukesh Butani, well-known tax lawyer and founder of BMR Legal, based out of New Delhi, and I began by asking him if there was a delay in the process of bringing about this global minimum tax rate and where things stood right now.
Well, the recent developments is certainly connected with the global minimum tax, but it's not something that has just happened. It is something that had been evolving for the past year and a half. What happened on 15th of August is that the ad hoc committee in the UN voted, overwhelmingly 110 positive votes to what they call it as come out with a new international standard for the UN. This is actually the first step, which is towards the new global order by the UN. To some extent, it does cast doubt on the ongoing OECD process, which, of course, is at a very advanced level. How that process is going to work on a go forward basis, what kind of frictions it is going to cause, only time will suggest so. But I can merely say that the August 15 development is now going to translate into this vote being taken to the UN General Assembly, being voted upon. After the UN General Assembly, there will be a 3-year time frame by which the UN will evolve new standards, which is in 25, 26, and 27. And this 3-year discussion would be undertaken by the intergovernmental companies, which will translate into what they call as the final text of new convention, which will then be voted upon, and the new UN Global Tax Treaty standard will evolve, which of course countries will have to sign and ratify separately. So that's really the big development that occurred on the 15th of August.
Right. So now all of this is making it sound like it's a little further out than what one believed, including the fact that India too was supposed to bring it on board in the last union budget last month.
Yes. So, what India was supposed to bring, and it is still on cards, is to implement the Pillar 2, which is the global minimum tax, which was signed first supported by the G7 in July 2022. And thereafter, it garnered support from rest of the countries, and 140 odd countries are signatories to that. That process has gone back and forth for a while. It hasn't been finalized, but the fundamental framework has been done. There are 40 countries that have already legislated. India is not one of those 40 countries, but For what we understand from colleagues in the North Block is that the legislation is ready. It is yet to be rolled out, which the government can easily introduce by way of a separate bill, or it can introduce by way of a subordinate legislation such that in 2025 that's made effective. However, the recent UN vote or the ad hoc committee vote has put many questions in the minds of people as to how these processes are going to work parallelly. The global minimum tax does tend to address some of the challenges of digitized businesses, and that's also one of the challenges which is there in the UN process as well.
Right. So, if I were to now ask you about companies operating in India, or for that matter, even Indian companies who are operating elsewhere in the world, how could this apply conceptually? I mean, before getting into how it could work practically, but how would a minimum 15% rate work and who could be affected as things stand?
First of all, it applies to companies that have a global turnover of about 750 million euros, whether they are Indian multinationals or they are foreign multinationals. They all are subject, they all have assumed that they all have international operations. They all will be subjected to a global minimum tax of 15%. Of course, that's easy said than done. In order to make the 15% global minimum tax applicable, there would be certain treaty related anti abuse provisions, and there would be certain domestic law anti abuse provisions. For example, there is a concept of top up taxes that needs to be paid by countries to ensure that a multinational pays tax at 15%. There are subject to tax rules, which are treaty driven rules by which you introduce anti abuse provisions in situations where there are certain countries where they do not pay the 15% rate of tax. So, combination of domestic law and treaty related provisions will ensure that this 15% tax is the minimum tax that multinationals pay in each jurisdictions who have global turnover above 750 million euro.
And in your understanding, there are companies in India or companies that we can see who are right now not paying that level of tax, and therefore that law would bring them under that purview.
Govind, I won't like to generalize, whether there are companies in India that are facing that. However, if you look at it from a global multinational standpoint, many businesses which are operating in a digitized environment, they are the businesses who are able to take shelter of what is called the century old tax treaty standards, which levy tax on economic nexus. And economic nexus means that you ought to have an operation in a country, and without an operation in a country, you cannot tax it. So these standards are meant to look at those forms of business models rather than the traditional forms of business models. Having said that, you can really put those class of taxpayers in two categories. One, that are highly digitized, the Amazons, the Apples, the Netflixes of the world. Second, traditional brick and mortar businesses, which do have an e-commerce model as well. So both businesses would equally be covered.
So let's say a country like India, and this is more a layperson's question, has a minimum corporate tax that any company in India pays, let's say 30%. Now, if you're paying 15% and you come under this, why would you not be pulled into the 30% or the regular peak level that everyone else is paying?
So domestic companies for domestic businesses will try to levy 30% tax. The 15% global minimum tax is to prevent a situation where any jurisdiction, and obviously India is not covered in that jurisdiction, does not levy the minimum 15% tax. Then India assumes a right. A classic example would be an Indian multinational operating in a jurisdiction, let's say, for instance, Middle East, which does not levy the 15% tax. India then assumes right through the treaty network to levy the tax, or that country assumes right levy a top of tax. That is how the whole system works.
Right. Mukesh, thank you so much for joining me.
Thank you, Govind.
Air traffic continues to grow in India. India's aviation industry is continuing to grow, though maybe slowing seasonally somewhat. Indian carriers flew close to 13 million passengers in July, an increase of about 7% compared to the year-ago period. Official data that's released by the Director General of Civil Aviation on Monday said. However, air traffic in July was lower compared to the 13.2 million people carried in domestic airlines in June this year. Passengers carried by domestic airlines during January to July 2024 were about 92 million as against 88 million in the same period of the previous year, thus growing about 5% or little less than 5% and a monthly growth of 7%, the official figures said. So all in all, the Indian domestic aviation industry is growing. Mars joins Pringles. You would have heard of Mars, the candy giant or chocolate brand, and Pringles, the chips. Well, the family-owned candy giant Mars is buying Kellanova, the company that owns Pringles, in a nearly $36 billion deal, bringing together brands from M&M's and Snickers to Pringles and Pop-Tarts, which is also the year's biggest deal to date, according to Reuters. Importantly, the deal is a bet on consumers continuing to indulge in branded snacks and comes as packaged food companies are seeing stalling growth after years of price hikes to cover skyrocketing inflation. The combined company aims to hold prices steady, Mars CEO told Reuters on Wednesday, and will not pass on costs from the deal to consumers. So the point to note is this. Food prices in the United States have increased about 25% from 2019 through 2023, far more than other categories such as housing and medical care, according to data from the US Department of Agriculture. Consumers in the United States and Europe, major markets for both companies, have been looking for cheaper alternatives or ditching brands for cheaper private label goods. There are similar pressures playing out in the quick service restaurant or brands like McDonald's and Burger King, but that's something that we'll come to at another point. Interestingly, there is another angle to think about for such companies in the Western markets and quite likely at some point in India as well, which is that a decline in sales from the greater adoption of drugs such as Ozempic and Wegovy for weight loss, which curbs appetites and leads to a feeling of fullness. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.